What if I told you the very first financial bubble in history happened long before stock markets, central banks, or even modern capitalism existed, and that the psychology behind it is the same psychology driving Bitcoin today? Because bubbles aren't created by technology. They're created by human nature. This is the story of a moment when an entire nation lost its mind, when fortunes were made and destroyed in months, when speculation became religion, and when people believed prices could only go up forever. A moment terrifyingly similar to the world we live in now. This is the story of the first financial bubble and the uncomfortable lesson it teaches us about Bitcoin, digital assets, and the future of money. Our story begins in the Dutch Republic, 1630s. The Netherlands was the richest country on earth. Global trade, booming cities, and one of the world's first stock exchanges had created a new merchant class hungry for wealth. And into this world arrived a flower, not a rare metal, not a discovery, a flower, the tulip. It came from the Ottoman Empire, and Europeans had never seen anything like it. Exotic colors, patterns like flames. So beautiful that nobles and wealthy merchants began collecting them like art. At first, tulips were simply a luxury hobby, rare, costly, prestigious. But something unexpected happened. A virus, harmless to the plant, caused tulips to bloom in spectacular, unpredictable patterns. The rarest patterns became legendary, and so tulips transformed from flowers into status symbols. That was the spark. But the bubble needed fuel, and the Dutch economy was full of it. As tulip prices rose, merchants noticed something. You didn't need to love flowers to love profit. Soon, tulips stopped being plants and became contracts. Traders bought and sold tulip futures, agreements to purchase bulbs months before they bloomed. It was the 1600s version of crypto futures. Paper claims without underlying assets. Leverage before leverage had a name. A tulip with a particularly rare pattern could cost more than a house. In some cases, more than the salary of a skilled worker for a lifetime. People traded votes, livestock, even entire estates for a single bulb. As long as prices rose, everyone believed they were getting richer. The pattern was timeless: scarcity, speculation, hype, FOMO, irrational confidence. It wasn't about flowers anymore. It was about the belief that someone else will always pay more. Sound familiar? Every bubble has the same hidden flaw. It relies on the assumption that there will always be a buyer. But in early 1637, at an auction house in Haarlem, something strange happened. No one placed a bid. One failed auction was enough to ignite panic. People who had spent fortunes on tulips rushed to sell. Prices plunged overnight. Merchants who had used their homes as collateral defaulted. Contracts became worthless pieces of paper. In a matter of weeks, tulip prices collapsed by over 95%. A bulb once worth a mansion was now worth the price of an onion. The first global financial bubble had burst. But here's the twist: it wasn't about flowers. Tulips were simply the mirror reflecting human greed, fear, and the dream of easy wealth. The same psychological patterns that fuel bubbles today. The crash rocked the Dutch economy. But more importantly, it shattered trust. Merchants who once believed in infinite growth realized they were holding illusions. Debt piled up. Contracts became disputed. Lawsuits flooded the courts. The government considered bailouts but backed away. Politicians argued that tulip futures were gambling, not real debts. Sound familiar? 1600s. Tulip traders demand government intervention. 2008. Banks demand government intervention. 2022. Crypto exchanges collapse and demand liquidity. Different asset. Same cycle. Because bubbles don't happen when prices rise. Bubbles happen when the leaf outruns reality.
After the crash, Dutch authorities attempted to regulate tulip contracts. Some wanted to void the debts entirely. Others wanted to partial repayment. Some wanted to force full payment. No one could agree. Why? Because tulips weren't the real problem. The problem was leverage, speculation, and the speed of mania. And that problem never truly went away.
It resurfaced in the South Sea Bubble, the Mississippi Scheme, the Railway Mania, the 1929 stock market crash, the dot-com bubble, the housing crisis, the crypto boom and bust. Every bubble follows the same 4 steps: a new opportunity, exponential optimism, leverage hidden inside growth, a sudden collapse triggered by loss of confidence. Bubbles are not financial. They are psychological. And that brings us to today. Let's be clear. Bitcoin is not tulips. Bitcoin is technology. Bitcoin is monetary theory. Bitcoin is decentralization, digital scarcity, and censorship-resistant value. But the behavior around Bitcoin? The mania, speculation, hype, tribalism, fear, euphoria. That part is as old as the tulip bubble itself. Think about it. 1. Tulips had rarity. Bitcoin has scarcity. Finite supply drives value, but also speculation. 2. Tulips had unpredictable patterns. Bitcoin has unpredictable price action. Both attract collectors and opportunists. 3. Tulips created futures markets. Bitcoin created margin trading and perpetuals. Leverage turns enthusiasm into mania. 4. Tulip prices soared on the leaf. Bitcoin's boom cycles also run on the leaf. Narratives, community, and expectation matter as much as fundamentals. 5. Tulip mania ended instantly when one auction failed. Bitcoin has crashed multiple times, triggered by confidence shocks. MTGOX collapse. China bans. FTX implodes. Macro tightening. Confidence is the real currency. Here's where the parallel becomes uncomfortable. Bitcoin has crashed 80% or more multiple times, same magnitude as the tulip crash. At its peak, Bitcoin's market cap surpassed $1 trillion, larger than most countries' GDP. Over 30% of Bitcoin trading volume is leveraged derivatives, similar to tulip futures. 80% of circulating supply hasn't moved in months, signaling heavy speculative hoarding. And yet, Bitcoin still rises again and again. Why? Because unlike tulips, Bitcoin offers something tulips never had: a monetary philosophy, a technological revolution, a decentralized ledger, a response to fiat debasement. Tulips had beauty. Bitcoin has utility, or at least the promise of it. But the lesson from history remains: no asset, no matter how revolutionary, is immune to human speculation. Bitcoin is both technological innovation and psychological experiment. The tulip mania teaches us one thing above all: even the most brilliant idea can become a bubble if the leaf outruns reality. 1. Bubbles are a feature of human behavior, not a flaw of markets. The first bubble happened because people overestimated future value, underestimated risk, and followed the crowd. This pattern repeats across centuries, even with advanced technology. 2. Scarcity creates value, but not always stability. Tulips were scarce. Bitcoin is scarce. But scarcity fuels volatility when demand is driven by emotion rather than fundamentals. 3. Confidence is the real asset. Tulips crashed when confidence broke. Bitcoin crashes, then recovers, based on belief cycles. Fiat currencies also rely entirely on collective trust. Money, markets, assets. Their value is built on belief, not material. So the question for today isn't whether Bitcoin is a scam or a revolution or the future of money. The real question is, can Bitcoin escape the fate of all assets driven by human psychology, or will it become something entirely new, a technology powerful enough to break the cycle of bubbles, or the next chapter in a 400-year-old story? Only time will tell. If this documentary gave you a new perspective on Bitcoin, money, or financial history, hit subscribe, tap like, and click the bell so you don't miss our next deep dive, where we uncover the biggest bubble you've never heard of, and why it may hold the key to the future of global finance. History has patterns. We're here to uncover them.